One of the most common questions among stock market investors is how does inflation affect the market? So today we are going to talk about the impact of inflation on stock market and understand which industries are affected positively and which industries are affected negatively. But before we get into the impact, let us quickly go over what is inflation and what are the two causes of inflation. Inflation is basically when prices of things that people consume like food, oil, rent, clothing, medical care and so on go up over time. To measure inflation, the government agency called the Bureau of Labor Statistics in the United States tracks the prices of basket of everyday consumer items such as food, energy, rent, clothing, medical care and so on. Now prices can go up for two possible reasons. First, if the demand for goods and services increases but the supply stays the same, prices will rise because more money is chasing a limited number of goods and services. Second, if the supply decreases due to supply disruptions but the demand stays the same, prices will rise because the demand exceeds the supply. For example, during the Russia-Ukraine war in 2022, food grain supplies got disrupted, so prices of food grains went up, causing inflation. Inflation resulting from both of these reasons has a huge impact on the economy and businesses, which in turn impacts the stock market. Now that we know what inflation is and what causes inflation, let us talk about its impact on the stock market. My name is Kanak and welcome back to my channel. If you want to learn more about such interesting topics from the world of investing, then subscribe to my channel. And your support is what keeps the channel running. So show your support by liking the video and sharing your thoughts in the comment section below. So many economists believe a small and steady inflation is good for the economy because when people expect that prices will go up in the near future, it encourages them to spend money. This spending helps to increase the demand and consumption in the economy, which leads to its growth. However, in a deflationary environment, which is the opposite of inflation, where prices are going down, people might choose to wait to spend their money, hoping that the prices will drop further. For more than 25 years, Japan's government has been fighting a battle against deflation, which has kept its economy stagnant. So, a small and steady inflation is healthier for the economic growth than deflation. Now, to maintain this healthy economic growth, the US Federal Reserve aims to keep inflation stable at a target rate of about 2% each year. While it's good to have low and steady inflation, if inflation suddenly shoots up or stays high for a long time, it can hurt the economy and businesses. That's because during times of high inflation, the input costs for businesses increase, but not all businesses can raise their selling prices immediately. Only businesses with pricing power, such as businesses that sell items of necessity, can raise the prices immediately as soon as the cost of production increases. Secondly, high inflation means people have less money to spend on discretionary items, or in other words, items that are non-essential like vacations, cars, eating out and so on, because more of their money goes towards basic necessities like rent, food and energy. So companies selling discretionary products like travel, car or restaurant might see a drop in demand, which could impact their revenues. So high inflation can lead to increased cost and decreased demand for discretionary items, which in turn can shrink profits for many businesses in the short term. Even though businesses and consumers adjust to increase prices over the long term, in the short term, high inflation can hurt businesses that sell non-essential items and cannot raise their prices easily. But some businesses actually do well during times of inflation, as they can increase their selling price to cover for higher input cost. For example, oil and energy companies typically tend to benefit a lot because often inflation has a strong correlation to oil prices. And during times of inflation, as oil prices rise, so does the revenue of oil companies. Secondly, real estate or equity real estate investment trusts that generate income by renting out properties make more money in high inflation environment because rents tend to rise during times of high inflation. Thirdly, companies that provide essential utility services like electricity also do well because people have to pay for these things irrespective of the economic situation. So stocks and assets in these industries typically tend to do well in times of high inflation. Now, the second reason inflation hurts stock prices is because during periods of high inflation, the central bank often raises interest rates to control inflation, and raising interest rates negatively affects stock prices. This is because interest rates and stock prices tend to move in opposite directions. When interest rates go up, stock prices tend to go down, and vice versa. I have explained the impact of interest rates on stock prices in a separate video, and check out the description for the link to the video. One of the reasons why interest rates and stock prices have a negative correlation is because when interest rates are high, safer investments like government bonds become more appealing compared to riskier options like stocks. As a result, the demand for stocks decreases, leading to lower stock prices. Now you might be wondering, why does the central bank raise interest rates in times of high inflation? The central bank raises interest rates during high inflation to make borrowing more expensive, which reduces the amount of money circulating in the economy. When money supply in the economy decreases, people and businesses have less money to spend, which reduces the demand, which in turn helps to cool off inflation. When interest rates are high, value of immediate cash increases because it can earn higher interest income in the present times. So a high interest rate environment, which tends to be a result of high inflation, benefits value stocks. Value stocks, which are usually more stable and established companies, tend to do better in this situation. That's because the money they make right now becomes more valuable than the money growth stocks might make in the future. Think of it like this. With high interest rates, having cash on hand right now is more valuable than promise of cash in the future. Value stocks often produce steady profits in the present, making them more attractive during times of high interest rates. Growth stocks, on the other hand, might be promising big profits down the road, but those future profits are not as appealing when interest rates are high. Now let us summarize how inflation affects the stock market. Firstly, high inflation can make profits shrink for businesses selling non-essential items due to increased input cost and decreased demand. Industries like energy, equity REITs, and utilities often benefit from high inflation because they can pass on the higher cost to consumers. Inflation also leads to higher interest rates, which in turn lowers stock prices. Finally, a high inflation environment tends to favor value stocks, which generate more cash in the present compared to growth stocks. I hope you found this video helpful, and let me know your thoughts in the comment section below.